Hello, this first week of People, Planet, and Profit, we're just going to cover some introductory topics in the class. As an interdisciplinary gen ed class, this class is open to all majors, but there's a lot of business content in the course. And so to help people who haven't taken any business classes before this, we're going to go over some concepts for business, some vocabulary, and some discussion about a lot of the topics that we'll be covering throughout the semester. Okay, so I apologize that these slides didn't get updated. This is normally a May term class. This is being offered this fall only to try to help students who are on the old gen ed plan get through and get graduated. After this year, ID classes will no longer exist, and they'll be transitioned to the new gen ed plan, and normally this class is only taught in May term. So I've just adjusted my May term class to fit the fall semester. So I'm going to have a separate video actually that goes over where to find everything in the course, and this video is just going to cover concepts. Okay, the People, Planet, Profit is based on the triple bottom line. So the triple bottom line can be broken into 3 P's: profit, people, and planet. And what the triple bottom line focuses on is that firms shouldn't only look at making a profit, that businesses shouldn't make profit their entire focus, but instead they should recognize that they are impacting the communities that they operate in. They impact the people who work for them and the people who buy and purchase goods for them. They have impacts on the planet through various things. Depending on what the business is doing, their environmental impact is different. But it's really looking that firms should be more holistic when looking at how they do business. This is a graphical representation of the triple bottom line, where we have the environmental, that is the planet side, social, which is the people side, and economic, which is the profit side. This graphic also shows some intersections of the environmental and the social, the environmental and the economic. So different things like if we are using natural resources in our business on a regular basis, there might actually be tax subsidies, tax breaks, different kinds of economic incentives for us to maybe switch to wind energy or switch to solar energy, where if we switch to an alternative form of energy, that would actually bring money into our business from the government and could potentially lower our environmental impact. So looking at those different things that companies can do throughout, we're going to talk about each one of these separately throughout the semester. Okay, corporate social responsibility also falls under triple bottom line. So CSR is the short of corporate social responsibility. This terminology really became popular in the early 2000s and looked at how corporations needed to be responsible for the both their economic impact and the environment they worked in, but also for people. In the early 2000s, they had a lot of issues with sweatshop labor, a lot of people being injured on the job, a lot of really bad working conditions. especially in other countries where American companies were using overseas labor, but that the working conditions were severely, really, really bad. And so people said that corporations should be held accountable to these things. And they started boycotting corporations for having sweatshops or being found out. There was a documentary on Nike called Beyond the Swoosh, and it's about a 25-30 minute documentary. It's free on YouTube. It was made in 2003. And this is a good example of where Nike was asked to be held accountable for the conditions of their overseas factories. Nike said that they couldn't be held responsible for the working conditions in the factories because a lot of corporations say, because I'm a US-based company and my factories are in other countries, I don't control the laws there. So I can't tell them to treat their workers better or only work 40-hour work weeks because those laws don't exist in their countries. I also can't force them to pay their workers more or other such things. Well, people started to boycott Nike and called on them. They said, actually, by being a business partner with this factory, you're condoning this behavior. And you can say, since you're such a large company with a lot of power, you can tell these factories, if you don't comply to our rules, we're not going to continue to do business with you, and we're going to take our business elsewhere. So both the documentary and the social pressure that Nike was getting, college athletics started boycotting and said that they were no longer going to use Nike for their athletics. They asked their colleges to sever contracts with Nike, and Nike finally came out and they said, okay, we are going to fix this. And so they did create a set of requirements for doing business with Nike that they make these factories follow now. So they are one of the first corporations to release a CSR statement. Now a lot of corporations release, as part of their annual report or in addition to their annual report, information on their corporate social responsibility activities. ESG is the most current terminology for corporate social responsibility. ESG has become popular in the last few years and has started to replace CSR as the terms used for talking about what companies are doing in this space of people, planet, and profit. So ESG stands for environmental, social, and governance. You can see that they have very similar categories to the people, planet, and profit. The profit category has been switched a little bit to add in some extra governance things, such as making sure companies are ethical, that they are taking care of their stakeholders and their shareholders. We will talk about stakeholders and shareholders next week when we cover chapter 1 and 2, which focuses on the difference between stakeholders and shareholders for companies and the different ways that companies interact with them. Then now we're going to talk about forms of business organization. This is something that a lot of people don't understand. And actually, I was teaching this class one time and I said something about not all businesses being corporations. And a couple of the non-business students asked me to clarify that. And that's when I realized that I needed to add this concepts and definitions. So the three major forms of businesses in the United States are sole proprietorship, partnership, and corporation. The most common form of business in the United States is sole proprietorship. A sole proprietorship is a business owned by one person. So I go out and I decide to open my own business. The advantage of being a sole proprietorship is that they are very easy to start. In the state of Iowa, it costs about $75 to file the paperwork with the state and $200 to get a tax ID from the IRS. That paperwork automatically registers you as a business and you can start doing business. It is the least regulated form of business. Corporations are the most regulated. The owner keeps all of the profits that are left over after the business's expenses have been paid. Some disadvantages of owning your own business is that the owner is liable for everything in the business. This idea of unlimited liability. And this is really, if your business loses money and isn't making a profit and you have to put more money in, you're the only source of income for that business then. It is difficult to sell ownership. Really, if you want to sell your business, who you're selling to needs to become a new business or needs to purchase that entire business. Corporations are the easiest for ownership transfer. And we'll talk about that in a little bit. So how much money you have available is limited to how much money you have as a person or how much money the bank will lend you. There are some different ways to get money as a single owner from different business think tanks or venture capitalists, but the most common way that individuals start businesses is with their own money or a loan. This unlimited liability also means that the owner, if for some reason you go out and you open a business and something happens, let's say someone gets injured at your place of business. If you are a sole proprietorship and you are sued, in addition to taking all of the assets of the business, they can take all of your personal assets too. So if you lost a lawsuit and they said you had to give this person $1 million and your business was only worth $400,000, then you would also have to sell your home, your vehicle. They can come after your personal property. This is not true with other forms of business. There is a legal way around it called a limited liability corporation. Any business, including a sole proprietorship, can become a limited liability corporation. This is, again, another piece of paperwork, some lawyer fees, but you can become an LLC. So if you see that behind a business's name that they're an LLC, it means that they've registered some additional paperwork to protect their personal assets from the business's assets. Okay, I'm going to end this video here and we'll continue talking about types of business in the next video.